Hi, this is Diane Crocker. I'm here with Clint Myers at PPR, who I interviewed for another Common Ground podcast in July. We're here at the RTM Contaminated Property Transaction Conference in San Francisco. Thanks for joining us, Clint.
My pleasure, Diane.
The first thing I wanted to ask is, obviously a lot's happened in the market since July. What are some of the most significant things, and what impact are they having on commercial real estate transactions?
Sure. Yeah, a lot of things have happened since July, where we actually thought we were starting to see a bottom being formed post-Bear Stearns. And then what happened was really a couple things. And the most important was Lehman Brothers. The decision to allow Lehman Brothers to fail sent a signal to the market that really shook up really the entire financial markets for July, August, into September. That combined with Fannie Mae, and these combined to allow AIG to get in the position they did, and these others. So it sent a signal to the market that the government was not going to backstop everything, and that some firms were going to be allowed to fail. And what this has caused in the interim is a lot more losses in the financial services industry, which is flowing through right now to a lending environment which is essentially non-existent, forcing the government to step in as opposed to being the first line of defense in propping up firms, being the back line of defense and actually trying to fund them and take investment positions.
Mm-hmm. And now here we are in mid-November, where the news just seems to get worse by the day.
By the day.
Now, I heard you say during your presentation that transactions will be down, was it by a third next year? Could you explain that a little more?
Sure. And it's surprising to people because 2008 has felt so awful. To think that 2009 could be worse is not something they want to hear. But if you really just look at the financing that is available, because you've got four sources of financing. You've got CMBS, you've got Fannie and Freddie, you've got life insurers, and you've got banks. Each one of them faces serious concerns right now, to some extent worse than they actually faced in the first half of this year. If you add that together with the refinancing that will need to be done on existing loans, then really what you have is about $50 to $60 billion of lending capacity next year from those four sources. Mm-hmm. If you can lever that to some extent, then what you can get is something on the order of $120 billion of transaction activity. This year there have been 180, and that's how I get that one-third. And those numbers obviously pale in comparison to what we remember in 2007, right, which was over $400 billion in transactions.
Yep. So if you're an environmental consultant out there, what they would be dying to ask you is, so where is the action? Where should they be focusing next year?
Where is the action? The action is going to be focused in a couple of markets. There are a couple economies that are holding up pretty well. And then more importantly, they are perceived to be holding up really well. Texas is holding up well. Seattle's holding up well. Denver's holding up well. These markets where the economies are reasonably strong, there's still a lot of investor appetite. So I would always look to that. Look to the local housing market. Look to the local job growth. Then there's some activity there. There's also going to be some activity in the large liquid primary markets. Core funds will be there. Foreign investors are always going to have appetite for these assets. So where we sit, San Francisco, there will still be activity. New York will have activity. Los Angeles will have activity. There's going to be some distressed activity in those markets. There's the housing bust markets. Phoenix will see some more activity. Florida.
And it might be foreclosure activity.
It will be, but it's still things churning. It's still finding price. So that in some senses it's bad, but it helps find a market. And for some parts of the market, all they want is activity. Activity is what is helpful. So there will be some. Where there won't be a lot of activity is the Midwest. Where things just continue to get worse. There's no desire for new development. There's no desire to own assets in that marketplace. In California, it will begin to get interesting because we think it will be one of the first markets out of the recession. So you might see some capital start.
California's always first.
Exactly.
In everything.
Exactly.
Okay, last question. At some point, things will turn around. I mean, they always do. The market's obviously cyclical, and what none of us know is when that will happen. So I'm curious about the signs that you'll be watching that will be triggers that maybe we hit bottom and things are actually turning back up again.
Sure. I think one of the signs that you'll see is whenever the financial markets and the housing market finds its way to, say, the money section of the newspaper and not the front section.
Yeah.
Right? That's a good sign. And also some of these measures that are thrown around in the press, which are LIBOR spreads. So once banks feel comfortable lending to one another, Then they'll feel comfortable lending to you and I and to businesses, and then eventually to commercial real estate investors. And that'll get all of the wheels churning again. But fundamentally, the banking system needs to heal itself, and it will have healed itself when it's not being every headline that we see on the news, the newspapers, and everywhere on the popular press. So there's still a lot to work through, I would say.
Yeah.
In 2009 is going to be a rough year because we're going to have that to work through along with a continually worsening environment. But those are the signs that I'm looking for. Really, the banking environment. How much are they charging customers? What is their lending volume? And when does that really turn around?
Yeah. Good intel. Well, we'll stay in close touch as things change and hopefully improve
Absolutely.
sooner. Thanks, Clint.
My pleasure, Diane.